Well, good evening, everybody. Welcome. Market Monday. We're live, ready to go. Got a good one for you today, guys. Market's been crazy. We could say that any day, right? Markets are always moving, things are always happening. But of course, this year, 2022, things have been crazy. And I want to hit on that in a practical way. Navigating bear markets, a new series we're going to do. How do I insure my portfolio? I told somebody the other day, you can buy insurance on your retirement account, right? You can buy insurance on your retirement or any long-term investments that you have. There are special little things we call put options that are designed to give you insurance. And this person said to me, I had no idea we could do that. Never heard of that in my life. And I got to tell you, one of the things that I find most fascinating about learning the world of finance, which remember, this is Tradeway's journey, right? This is our motto, breaking down the confusing world of finance, right? Because a lot of it is not that complicated. Yeah, there are some complexities, but a lot of it is not that complicated. It's just that it's been made to sound very complicated. It's very distant, and we're here to help bridge the gap. So I told this person, you can do this. They said, I never heard of that. And what I've found being in this community at Tradeway over these 6-7 years I've been here, learning a ton, is that a lot of the things we can do, folks like you and I don't do, not because we couldn't, or not even because we wouldn't, but because we had no idea that they even existed and could be used. And guess what? Wall Street has been using them forever. I say forever, decades, in some cases longer. And that's what this is. Listen, I want to tell you this right off the bat, okay? And I believe I mentioned this last week. Potentially it was the week before, right? This is where we have a little bit of real talk. A lot of people are losing a tremendous amount of money in the market. Now, long-term investments, they ebb and flow. There is an ebb and flow to it, okay? But when somebody sits down with me and they say, Blair, I've lost 25% of my retirement, and people are talking like the market has not bottomed, which, by the way, we don't know where the bottom is. We're seeing a little bit of a bounce right now. We're going to look at that. But that doesn't mean we're out of the woods yet. The news for the medium and long term in our market is atrocious. It doesn't guarantee a major crash. It never does, right? We don't come on here and use our crystal ball. We come and we manage risk. And I'm going to give you something very practical today. If you even only understand this, it's going to serve you. All right? You may even put it into practice, and certainly we can help you do that. But having a plan for a bear market, having a plan should we see that happen. I spoke to some folks recently, and I mentioned the market is getting a little bit of a bounce right now. And I was able to say to them as they told me, wow, we've lost a lot. We've lost a lot. And we're glad it's starting to come back a little bit because we're starting to make a little bit of that back. But a lot of times in these bear market environments, it's that little bit of a bounce before a drop. Let me show you this. While we're jumping over here, if you are joining tonight, as always, know you can go ahead and light up that comment box. Our Facebook friends, our YouTube friends, doesn't matter where you're coming at us from. Go ahead, say hi to me. Let me know where you're from, what's going on your end of the screen. Any questions, concerns, comments, you name it, that you might have as we move through this, go ahead and pop that in there. I'm putting my screen up on here so y'all can see it. Let's just quickly go over to a chart of the S&P 500. What does that look like right there? Right? Looks like a downtrend. You know why? Because it is a downtrend. So yeah, the market's bouncing. Notice on the left side of the chart, that old resistance, right? It used to be resistance, and now it's become, in multiple spots, it's become support. Okay? Now, the market doesn't have to continue to respect these lines over the long term. But remember, when we're in a downtrend and we have not confirmed an exit from that, which we haven't, you can see we're not at the resistance line yet, which is right at that 50-day moving average. All right, I'm interested to see how the NASDAQ holds up after today's close. And ultimately, if this S&P here can move up to the 50-day, that'll be a decision point for sure that I think will be a big deal for the next month or so, right? Because we've got to see if we can hold on in this downtrend or not, right? What's my point, though? Well, we might be moving back up, but this is where a lot of people get caught, right? We see bounces, but the overall trend is still negative, and bounces are normal in downtrends, right? Stocks don't go down forever. Markets don't go down forever, right? And then we can get caught in that whipsaw. We have to watch. We have to wait. We have to see. It's good to have a skill set, right? It's good to join the conversation with us here at Tradeway and just get an idea of how these things ebb and flow every day so we can make some decisions. Troy says cool rain here in Houston. Well, that's a good thing. Cool rain is a good thing. I don't know if it's cool in Houston very often, so that's good to hear. Let's see. Nodak Hunter says, hey, took a position in the SPX today, right? If it opens green, I'm selling the position. So it looks like you did something maybe right around the 20-day there. Just looking for a quick bounce right off that short-term support level. We use those moving averages. In fact, we have a topical coming up where we're going to teach all about moving averages. A free topical we do. We're always doing stuff here at Tradeway to teach you guys all kinds of market information. And this is free to come and join this class. Of course, that's what we do right here every Monday night as well. So good for you getting out there, getting active. We need to have an understanding of those skill sets, where we're going to get in, where we're going to get out, where we're going to stop out, and all the space in between. So I appreciate you sharing that for us today. We got to see, like if I go over to the chart here, you can see this old level right here. We're kind of right in there, but we closed above that 20-day, right? So who knows? We might use that. Point being, we're in that downtrend, okay? So the market hasn't convinced us. The economy certainly has not convinced us that we're going back to all-time highs. Now, we may chip away and get some of that account back if somebody out there, and I'm sure I'm speaking to somebody on this, has seen significant losses. But even then, as I spoke to this individual more recently, as I was saying, they're hoping, hey, I hope we get a lot of that back. Well, you got to have a plan in place if it doesn't work that way. What can you do? What can you do? I mean, the market was down about 24% about a week ago, okay? We're at about 18 now. That's a good size bounce. And we looked at bear markets in the past to see that bear markets tend to have pretty violent bounces. And again, that's one of the tricks that can and has historically happened repeatedly with these kinds of crashes, because the market likes to go up for 5, 6, 7, 8, 10, 14 years, right? Now, there are corrections in there, but major bear market crashes, it's been a long time, right? And I'm not really counting COVID here. COVID was a big crash. It was a very unique circumstance, all right? It was real, but it came back very quickly. It's the first time we've ever seen that happen, and it was stimulus that did that. We've talked about that at length the last few weeks. The point I want to hit at today is we've got to have a plan, because we can get sucked into the market again when it's buy, because we think, oh, the market just likes to go up. But if we're truly in a bear market and a recessionary season, then those bounces, if they become buy-ins, are places where we get burned, okay? And that's not what we want. So what can we do, especially with long-term money, right? Especially with long-term money, but also with short-term. We've talked on this channel about options, okay? Now, we talked about options the way we like to use options around here at Tradeway a lot. We're primarily options traders here, and we like to buy the options contract and sell the options contract at an advantageous time, right? I want to buy a call option when the stock is going up, and I stand to make money when I do that, except I only spend a fraction of what I would have spent on the stock because I didn't buy the stock. I bought the contract. Same thing on the put side, right? That means that the contract increases in value when the stock moves down. This allows me to approach the market when it's moving up and when it's moving down for short-term opportunities, okay? And I can do it at a fraction of the cost of buying the stock because, again, I'm not buying the stock, I'm buying the option. The option gets its value from the stock. If you didn't see our options preview that we did earlier this year, we talked about a lot of these concepts. Remember, you can always go back in YouTube to history, right? It's all in there. Every single episode we've ever done is in there. You can go back and you can watch that. But calls make money when the stock moves up. Puts make money when the stock falls. That way, we can be involved in the market both ways, and we don't have to short the stock, which we explained last week has unlimited risk. Unlimited risk. We don't want to do that. Options have limited risk, okay? So, markets moving down, put options make money when the stock moves down. So that presents an interesting opportunity for us, doesn't it? Okay? Remember, and maybe you didn't know this, right? There was a time where I did not know this. We primarily trade options here at Tradeway, but the original intent, right, for options contracts was as insurance. They were insurance contracts, okay? If I have a car and I pay premiums and buy insurance on that car, most days, hopefully, you're not getting in an accident, right? The value of that car is, I should say the safety of that car is something that we care quite a bit about, right? But sometimes things happen. You can't always control it. And so you have insurance, right? It covers the cost. We have home insurance. We have health insurance. We have car insurance. Things that can be financially overwhelming, we have insurance. Well, our retirement is pretty important, isn't it? Right? This is something we don't want to believe. We don't want to accept a lot of Wall Street, what's the word? Just financial advisory doctrine that says if we've got money in the market, we ought to leave it in all the way down. There are a lot of advisors that don't do that. We don't do that. Okay, we do not do that at Tradeway. And we have not been doing that for our folks who have been a part of our AMPed program we talked about last week. Okay, we actually had a free informational webinar. Perhaps some of you guys joined that. We talked about it last week. So you could see how we do that here at Tradeway. We don't leave it in all the way down. But there is something we can add to this where we're saying, well, I insure all these other things. So why wouldn't I insure this? I've got a retirement account, right? You may be in your 20s and just starting out. I don't want to give back what I've started and made. You might be in your 50s, your 60s, and you definitely don't want to be giving back what you've made, right? If we go into a full bear market crash and you're at 57 years old, even 50, right? This matters no matter what age you're at. But as you get even closer to retirement, somebody telling you it's okay, it'll come back is not so comforting, is it? Right? That's not so comforting. I'm going to go ahead and take this off the screen here. What time frame is the chart? That's a daily. That was a daily chart. It was a daily chart. I always start with the daily. Moving to other time frames from there, but always starting with a daily chart. Troy says, good time to learn puts. It's a great time to learn puts, right? If you want to be active in this market environment, if you want to have protection on your portfolio, right? This is one of the ways to do it. It's not the only way to do it, but it's one of the ways to do it. I'm establishing that we have insurance for everything else. Well, as I told this individual the other day, you can buy insurance on that. He said, I've never heard that. Well, today, if you're on this broadcast, if you're watching by recording, I know a lot of our friends will join us on recording. I'm letting you know you can have insurance. It's called a put option. Now, that's downside insurance because, of course, your portfolio stands to appreciate if it goes up. Now, you may not want to exit the market, right? We can really only do two things in investing and trading, okay? Basically said, we can put on a position, we can take off a position, okay? Now, we can put on a partial position to manage risk. We can take off a partial position to lock in profit. This is more of a trading concept, okay? But it works in longer term investing to say that we can put it on or we can take it off. But what if I add just another layer to that today? What if I don't want to take that position off? Right? You don't know what kind of upside we may still get. The Fed's still saying to some degree, hey, we're hoping for what we call a soft landing, which means they're going to raise those interest rates, try to crush demand in the economy, right? It's too hot. It's overheated. We've got 2 job vacancies for every person looking for a job right now, right? That's real hot. Inflation, real hot. Supply lines, right? All this kind of stuff happening. So they're trying to bring that down, but not trigger a recession. Now, it's not looking very likely that they're going to be able to do that, but let's say they do, right? Let's say our next inflation reading is lower, significantly even maybe, right? I don't see signs of that right now, but let's just say it's possible, because it is possible to see that improvement. And I would gather we're going to see the market rip quite a bit higher, certainly in the short term, if we see an impressive inflation number, right? That's going to pump a lot of optimism back into the market, and they're going to price that in. So you say, well, I don't want to get out, okay? Now, I would say once we were at 25% down recently, that was past time to have a plan. We talked about that last week, okay? But here we are. We're starting to see a recovery. Perhaps we move up, even break out of the downtrend. What are some things you might consider? Well, having that insurance or understanding how to approach that insurance could be something that you add to your arsenal, okay? Because that's something that is going to protect if you see another drop and you don't have to take that downside hit in the same way. Now, your stock, whatever you own, right, your long-term positions, that's still going to take a hit if the market is moving down. If I'm in a specific stock, an ETF or a mutual fund, and that goes down, I'm going to take a loss on that. It doesn't stop the loss. But remember, the put option will work inverse, opposite. It's going to make money if the stock is moving down, okay? So if we do see a bounce up and then a continual move down and insurance is in place, okay, at some point you can make what we might say a claim on that insurance. Because if you buy a put option and it increases in value, then of course you're able to sell that put option at a value, and you could then offset those losses, right? You could offset those losses. So that's what some consider using. It's one of the tools. So we talk about options. Now, remember, a call option, okay? A call option, when I buy a call, not a stock, but I'm buying a call option, it gives me the right, but not the obligation. I have the right, but I'm not obligated. I don't have to. I can, but I don't have to. See, I have that piece of paper, figuratively speaking, that contract, and it says that I have the right, but not the obligation to buy the stock at the strike price. The strike price is the agreed upon price that's on that contract, okay? I can buy it if I want. Well, if the market price for XYZ stock is $150 and I own the $140 call option, then I can buy the stock at $140 when it's actually market price $150. That makes that options contract more valuable than when I bought it, right? Now, the put works the other way. As a buyer of a put, I have the right, not the obligation, to sell the stock at the strike price, okay? I can force the sale of a stock at the strike price. And that means that I could potentially, if the market, XYZ stock, is currently at $140 market price, I can force the sale at the strike price. Let's say $150, right? That's $10 a share more than what I'd get at the market price. See, that contract gives me the right to do something that nobody would normally ever give me the right to do. Sell the stock, forcing the sale, right? At a higher price than it's currently at. So this is how put options increase in value. Now, if I don't intend on trading short term with the option and I have put options covering my portfolio, all right, we'll talk about that in a second, then it stands to gain value as my portfolio falls. So even though I'm not selling out of the position, I'm in a position where I can make money and try to get net zero on the losses versus the gains in the put options, where I come out not losing such a significant portion of my portfolio, right? In some cases, maybe a little bit less, right, making on the put options than what I lost, or even potentially making more on the put options than I lost in the portfolio. Now that takes us to an important point, okay? We wouldn't just go out and buy put options on anything, okay? Now, one options contract covers 100 shares of stock. So a popular approach, for the sake of going through this today on Market Monday and having some simplicity and understanding, a popular approach is going out and buying put options on an index, okay? Buying it on an index. We mentioned the SPX earlier, okay? The SPX, the SPY, right? The SPY, SPY, significantly less money, right, to buy into the SPY than the SPX. Obviously, you've got the NASDAQ, most popularly traded on the Qs. QQQ is the ETF for the NASDAQ, which is primarily tech stocks. If you had a lot of tech stocks, right, and we have a significant holding, there are different calculations on how to do this, okay, that we're not going to go into today. But you want to understand, how do I match what I have with the right insurance? Okay. And that's something that we want to teach you in our options program, where you understand how options really work and are priced, so that we can go into actually matching them. But it's an important thing that we understand. If I have primarily tech stocks, then looking at something like the Qs, something that's connected to the NASDAQ, or potentially I own a tremendous amount of even one or two kinds of stocks, well, then I might be able to just go in and go, you know what, I'm not necessarily going to buy a whole index. I may just go ahead and buy put options on that individual stock. Now, at this point, it's worth saying, for those of us out there who aren't particularly familiar with options, it is very important to understand how options work. I'm giving us a groundwork tonight that you can insure these, and that's the original intent behind options. So there's something there that can be very, very useful for us, but we need to learn how to use them, okay? And so with put options, this is something where I can go in and I need to understand that they have an expiration date, okay? All options, unlike a stock, have an expiration. So when we talk about that insurance, you and I could go out and potentially look. Let's talk about the SPX, because that came up in the comments. I could go out and I could buy a week worth of insurance in the SPX, right? I could do that, and in a week, if I don't do anything with it, it's just going to expire, right? It's just going to expire, and the money I put into that is going to be gone. Now, I could reverse that position before it expires, okay? But when it comes to options, we have to understand, when we're doing insurance on a long-term portfolio, we have to understand that we're not really going in to buy very, very, very short-term insurance. That's risky for us and doesn't give us the long-term coverage we're looking for, right? These are not quick short-term trades. These are long-term buy and hold positions. So we would want to look at insurance that is appropriate for our investing goals. That's something we would need to do with you one-on-one, but you would want to understand that options have a strike price and they have an expiration date, okay? So there are different options, and we talk all about this in our program, in our Step 2 course. I'm going to give you an opportunity to jump into an advanced options training course that we have coming up. If you've taken our Step 1 Start Your Journey course, you are eligible for this course, right? This isn't going to be for absolutely everybody. Now, you can jump into the Step 1 Start Your Journey course we've got coming up. In fact, I'm just going to go ahead and pull this up and give you the link, because I will actually be teaching this in just a few weeks. I'll just get it right here. And I'd love for you guys to join me, right? I'd love for you guys to join me. I'm going to go ahead and cut that. There we go. Because if you've never taken it, hey, guys, especially right now with what's going on in the market, come out, spend a little bit of time with me, It's less than $100 to learn something that could potentially save you thousands, tens of thousands, whatever you plan to make in the markets, you'd like to make in the markets, you want to protect in the markets, right? Whatever your goals are, we're going to give you a step in that direction. That's what this is designed to do. And we're going to do it for next to nothing. It's a lot of great information. It's also the prerequisite to our advanced options class that's coming up. So if a lot of this is really resonating with you tonight, I really need to know how to do this, okay? If you saw massive losses in your account and you felt helpless, I don't really know what to do, I have no idea how to do this, this is an opportunity for you to jump in and understand how you can move forward in this, because that is what we are going to train you to do. In fact, we're going to do a 5-day boot camp on options, okay? That is going to be awesome. So you could join us for that. I'm going to pop that link in there. But let me just say, looking at something that is going to insure my portfolio, that is possible. I want to understand that there's an expiration. I'm paying premiums. What's the risk here? Well, you and I could pay premiums on an account, right? Whatever the stock is, whatever the portfolios. Let's say we go out, we understand how many options to buy, and we do so, and then the market goes up, right? What happens then? Well, if the market goes up, the stock that we're in is going to increase in value. Guess what's going to lose value? The put options. But here's the cool thing about insurance, guys, right? What's your car worth? What's your house worth? What's your health worth? Okay? Do you pay the same amount on the insurance that you have? Now, some of us feel like maybe we get pretty close with health insurance. I know that can be pretty high. But ultimately, it's only a fraction of the value of what it's covering. And it's the same thing in the stock market. It's the same thing in the stock market. You're not going to pay the same amount for the insurance as you did for the value of what's being insured. You pay a significantly less amount to purchase the insurance, just like insurance premiums, right? On your home, on your car, on anything you pay insurance on. You pay those premiums. Does anybody like paying those premiums? Not really, right? Not really. Nobody likes paying those premiums. They come out every month. If you go a year and a half, 2 years, 10 years, whatever the case might be, you don't make a claim, then you go, should I really be spending this? But that's the thing that happens. When you need it, it's there. When you need it, it's there. And then when it's there, it's more than worth it, right? So if we decided to do put options and the market moved up, yes, our premium, which is what we call it, it would lose value. It would lose value, okay? But we paid significantly less than what we would have paid for the stock. So we could lose out on some premium, but that is how insurance works. And we only paid a fraction anyway. So it's actually a really cool introduction into an approach to saying, you know what, there could be a difference between me and my neighbor who lost 45%. We talked recently on how low the market could go. Some are predicting that we're not going to go much lower. Some market wizards are saying even maybe 55% back down to the COVID lows. Could that happen? Could. I don't think it's too sensational. It may not, but it could, because we've been there before. The market is incredibly inflated, and there are a lot of major economic headwinds which could synergize here to take us down to a significantly lower level. My thing for you tonight isn't that we have a crystal ball, but to say we have some things. As I always say, you don't know what the market's going to do. The job of a trader and an investor is not to know what the market's going to do. It's to know what you and I are going to do no matter what the market does. That's what this is about. And one of those things is, hey, I could look at potentially hedging that portfolio, insuring that portfolio, understanding how to use put options, right? That is the goal. Okay, so we can understand that there are opportunities here, and the reason I don't know how to do them is simply because I've just never been shown, right? I've just never been shown. So if you're interested in knowing more about our boot camp in options, I'm going to go ahead. I'm going to pop a link in there right now. It's coming at you, Facebook, YouTube, in the chat there. If you're watching this on recording, it's still going to be right there in the chat. It's posted on there for you. It's a little bit.ly link for you. And we've got this coming up, the boot camp. This is July 11th to 14th. Okay, July 11th to 14th. This is going to be our boot camp for options. So if you're concerned about this, if you're excited about this, listen, there's going to be a lot of opportunity. Bear markets bring a lot of volatility, and options can do very well in volatility. We have to learn to manage the risks. We have to understand what to do, what not to do, and put it in place. But it can bring tremendous opportunity. So that is key. And I'll finish with where I started. This isn't just technical information and knowledge, right? This is something that has and can make a tremendous difference between you and where you are and where you want to be in the future, right? Don't be someone who says, I don't feel empowered. I don't feel like I know what to do. I'm paying somebody to do this, and they may not be communicating with me. I looked at my statements. I was down 20, 25%, and I don't want to go back to that, but I'm just going to freeze and stay where I am, right? Let's help you get to a place where you understand. The mission of Tradeway is to break down the confusing world of finance, and we will do that for you. We help new folks. If you're anything like me, brand new in this world of finance, right? Brand new in investing, trading, all of this stuff. Blair, you're talking interest rates and Fed and I don't know any of that stuff. You will. You will. You will. We make it simple. We make it palatable. We make it understandable for you so that you feel like you can make some great decisions. And some of our coaches, you know, they went through the crash of 2000, lost 30, 40%. The guy told them, you know what? It's going to come back. And then 2008 happened and they lost 30, 40%. That's 8 years later. Hey, we don't have unlimited time, right? We might say that you can renew money, but you can't renew time. And that's true. Hey, but let's save as much money as we possibly can along the way because it can buy us freedom in our time. And that's what we want to protect for you. This isn't just about money. This is about what that represents for you, what you value, what you're working towards. Help us, let us help you do that in your money. That's what we do here at Tradeway. Appreciate you guys being on here. Is boot camp online? Great question. Yes. Yes, this will be entirely online, right? This is going to be in-depth sessions with our team all online during that week. You can click that link right there, and it's going to go through some of the details of what that is, okay? 11th to 14th, right? July 11th to 14th. It's all going to be on Zoom. All righty. Hey, appreciate you guys being on here today. This is the first of a series, Navigating a Bear Market, right? One of the ways to insure and hedge, but also remembering, let's go ahead and pop it up here as we close. We haven't broken that trend yet. So watch that 50-day moving average overhead. It's right on that support, or excuse me, that resistance line up there. I won't be shocked if we get up into that level and drop again, okay? Anything can happen, but it's on my radar, and now it's on yours too. All right, guys, appreciate you. Thanks so much, and good night.